Good morning, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Fund Development Analyst. We are pleased to welcome today Stéphane Corriveau, President and Senior Director and Chief Compliance Officer at AlphaFixe, here to talk to us about the SSQ Bond and Bank Loan Fund and the benefits of holding such a fund in today's economic environment. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Stéphane, the floor is yours.
Thank you, Matthew. Hi, everyone. So I will go to the presentation, and then I will be very pleased to answer your question. So if we go to page 2, you will see that the agenda of today, I will talk about the firm, the product, specifically about the bank loan, and finally about some economic that we see right now in the market. So let's begin with AlphaFixe. We created the firm in 2008. Our firm is specialized in fixed income. Our mission is to be a leader. For us, a leader meaning that we create value, we beat our competitor, and we find solution for our client. So it's not meaning that we'll be the biggest firm in Canadian fixed income, but we want to be the best. When we create the firm, we put 3 important things. The first one is a constant value-added creation. So we want to be the market, but a constant over time. We have a risk management process. Even if we manage fixed income, there's still risk in fixed income, and we want to be sure that we know all these risks. And we have a fundamental investment approach, meaning that when we invest in corporate bonds, we want to be sure that we understand where the cash flow came from, meaning that we look at the revenue, expense, and we have to have a profit. If the profit is generated because it go to some island, I don't know where, around the world, and came back in Canada, and it's make a profit, it's not like for our fundamental investment approach, so we don't invest in this kind of corporate bond. Page 4, the team. As you see, we have a very senior team of 19 persons. Me and Sébastien Rion created the firm 10 years ago. And the bank loan, Diane Favreau and Julie Prémont are senior portfolio management. So they are the two who make the call about bank loan. We'll discuss this later. And the team, as you see, we have a lot of persons that came from background actuary, economic, financial, accounting. So for us, it's very helpful to tag all problems that we can see. The last thing I want to talk to you is about Paul-Marie Vigneault. Paul-Marie is an analyst and a responsible investment, and Paul has a master in environment. So you will see that ESG is very important for us, and Paul-Marie is one of the person that manage this with Simon Sénécal. Page 5, in terms of the firm, we see we start at 2008, and SSQ was our first client, so we're very proud that we still have it, and we increased the relationship between both companies. And you will see that at the end of March of this year, we have close to $6 billion of asset under management with 62 clients around Canada. Most of it are in Quebec because we're well known in Quebec, but we last year we just won some mandate in BC, one in Saskatoon, and we have other in Ottawa. So AlphaFixe become the more and more new across Canada. ESG integration, as you see, it's not like marketing thing. We began in May 2008, and in April 2009, we become a UN PRA signatory, and we launched the first green bond fund in 2017. It was the first in Canada. Right now, it's right 144 million, but we're more around 150 million in the green bond fund. Other thing that is very important, we have received highest distinction for integrating ESG factor into our process from one global benefit consulting firm that we cannot name, but we were very proud because we are the only Canadian manager to receive this distinction in Canada. So this is about AlphaFixe. We'll now go directly to the product, SSQ AlphaFixe bond and bank loan product. So the first thing at page 8, you see that interest rates have decreased since the last 30 years. We began the graph in 1990, but we can go 1980, the same thing. And as you know, when interest rates go down, price go up. Okay, so when you invest in fixed income, you receive a coupon, and that time it was a big coupon, close to 10 or 12%. But to this coupon, we add the increase in price because interest rates go down. And the 3 red circle, if you go to other pages, we'll see this is the only return, the negative return, and the year, okay, happen when interest rates go up. So from the last 30 to 40 years, like investment and fixed income was really simple. You buy the coupon and you got an extra return because interest rates go down, except for 94, 99, and 2013, where interest rates go up. Okay, so nothing happened except interest rates go up. When interest rates go up, price go down, and when the price is going down more than the coupon, you have a negative return for the index. The problem is we think that in the next years, the next quarter, interest rate will go up. So what do we do with our fixed income? We create that product with the SSQ, so it's an active management product. Their objectives, we have 2, is capital preservation and high current yield. So we maximize the probability to have like a positive return in any business cycle. Very important for us. So where we are right now, we'll discuss this a little bit later. But for us, we think we are in a rising interest rate environment, meaning that we need a short-term duration. And we think that because we are at the end, close to the end of the cycle, we think the yield spread will increase, meaning that we don't want to have like a spread duration very high. So how can we do this? You will see that in page 11. First of all, we decrease the duration because the universe is the benchmark for all the manager, like in Canada, the FTSE Canada universe, have a 7.7 year of duration. This is a sensibility to movement in interest rate. So in our product, we decrease that to 3.6 years, meaning that we have 4 years less than the universe. What does that mean if interest rates go up? It means that we can create 4% of value added if interest rates go up like in 1 day, okay? So it's the duration gives you the sensibility and price. Normally, when you have a protection like this, your yield is lower because the slope normally of the yield curve is increasing. But when you look at our yield in our product, we have 3.2% compared to 2.3% in the universe. So as you see, it's very low yield compared to what we have in 19, but it is where we are right now. So even if we have lower duration, we have better yield. So we have close to 1% of carry that we call, meaning that if nothing happened, we're wrong, interest rate don't move, we'll still beat the benchmark by 1%. How can we do this? We have a mix of normal bonds, I will call it, provincial, municipal, corporate, and federal bond, and bank loan. First, if we look in our bonds, we have close to the same thing in the corporate bond. We have less federal bonds, but we have to compensate this municipal bonds that are close to the same as provincial bonds. But the main ingredient to our product is bank loan. We have 33% of bank loan in the product compared to 0 to index. What is important, if you go to page 12, and we will be back later, what is a bank loan? If you see that product will be good not only when interest rates go up, but also interest rates go down or don't move, because we manage this project actively, meaning that you see that the duration can go to -5 to +5 years compared to the benchmark. There's not a lot of money manager across the Canada that could have this bet. Okay, people normally stay very close to home, very close to the index. So for us, we think interest rate go up, so we decrease that. If interest rate go up and we hit the end of the cycle, we will increase the duration because it will be the reverse thinking. When interest rate will go down, we want to have duration. So we have 5-year upside to use it. After that, we have bank loan. We can go to 0 to 40%. Right now, bank loan give us very good yield, very good protection. At the end of the cycle, we like this. So we put 33. We can have a maximum of 40. And same thing happened with corporate, provincial, municipal bond, and federal bond. Federal bond, it's very interesting. You only need federal bond when you think that you're very close to a recession. That it's not our case. We think we are at the end of the cycle, but we don't see recession this year, maybe at the end of next year, depending what's happened, but it's not close right now, meaning that we don't like federal bond right now, but in the product, when we think it's time, we will put it on it. So for your client, AlphaFixe is doing all the call. We manage the duration. We manage what bond we want, what number of bank loan we want, and the product. So if we go to page 13, it's resume the product. We decrease 60% of interest rate risk because for the next quarter, we think that someone will invest in fixed income. The main risk is interest risk, and we decrease it. Normally, when you decrease that risk, it came at a cost. But for us, because we use bank loan, we have a high current yield that offer additional protection because you will see bank loan is very well positioned in the structure. And this is actively managed, so it's very good for us. So if you look at page 14, you will see that at the end of the April, we have a return of 4.3% compared to the universe of 3.8%. So we have 0.49 like percentage or 49 basis point of value added. Our target is 150. So we think that we will hit our target when interest rate will go up. If we look at the bank loan, the next page, you will see that it's very interesting because as you see, since the beginning of the year, bank loan have a return of 5.71, and it performed very well since the beginning of the year. So right now we go to bank loan. First of all, let me do a quick review of the duration. The duration, like I told you, it has an inverse relation, okay, with interest rate. So meaning that if interest rate go up, the price go down. If interest rate go down, the price go up. So the first thing to keep in mind when we talk about fixed income. Now, how much the price go up or down, this is directly linked to the duration. So as you see there, if the duration are longer, meaning I have more 10-year, 20-year, 30-year bond in my portfolio, I will increase the duration. So for the same movement, the same increase of 1%, interest rate go up, the price will go down more than when I have a smaller duration. Okay, so that is important to understand. So if we go to bank loan, we look at the capital structure of the bank loan. We'll give you an example with Burger King and Tim Hortons. When the company, the merger was done in 2014, it cost $27 billion. The buyer put $17.8 billion in equity. They were able to get $2.2 million in bonds, and they missed $6.8 billion to complete the transaction. So they go to a bank. The bank says, "Okay, I will lead you $6.8 billion, except that for that I will be the first lien." Meaning that if the company is sold, let's say $20 billion in 5 years from now, because I am in a bank loan, because I am the first in, I will be pay all my 6.8 billion. Okay, the person who invests in the equity will lose 7 billion. If Burger King Tim Hortons is sold, let's say 30 million in 5 years from now, the person who invests in equity will have a gain, okay, of 3 million, but I will still be paid 6.8. So as you see on that pages, before I lost 1 cent in a bank loan, okay, all the bonds and all the equity have to go to zero. I'm not saying that it's not impossible, but it's very, very extreme scenario that all the company go down. If the company is making less profit, the equity will go down. But because of bank loan, I'm the first in, I will be paid. See that picture of that company like a waterfall. The first 6.8 pay the bank loan, still money left to go to bond, still money left go to equity. So at the end of the cycle, we think that structure is very interesting. Second thing, it's a first in, but it's secure, meaning that when the bank lend the money, they ask with all the asset they want to the company. So if the company is not paying principal or coupon, you could take the company, okay, manage it, or sell the company to pay what? To pay the 6.8 billion. So again, it's first lien, secure. It's very interesting. The last point is that when you buy a company, normally you have the bank ahead of you. Now the bank is aside of us, okay? So if I lost 1 cent in that company, the bank will lose 1 cent. The bank are not before us. So they are at the same level, because when one bank say, I will lead you 6.8 million, okay, they do the same dig that loan, and like AlphaFixe will buy 50 million of that loan, meaning that we are the bank from Burger King Tim Hortons with the other bank and the syndicate. So it's very interesting. The other thing is the recovery rate. You will see that even if the company go down, because I am the first in, the secure, I have a recovery rate of 80% compared to 41% when we talk about loans. And the last point I want to make on that pages is that if you see, that was in 2014, but in November 30th, 2018, we give you the new value of the company. So equity have increased to 27.5, bond have increased to 3 billion, and bank loan are now 9.1 million. Meaning that now, for the 9.1 million of bond, I got 30 billion under us that protect us. So it looks like you buy like a building and you have a loan to value of 25%. Everybody will buy that building. It's the same thing happening with the bank loan. So if we go to page 19, if we resume the bank loan, first thing, secure, floating rate, meaning that the duration I talked before, the duration of the bank loan, it's only 3 months, 0.25 year, meaning that when interest rate, like the LIBOR, increase, my coupon will increase. It's what happened in 2018. So I got a LIBOR plus a spread plus a coupon. So eliminate interest rate risk. That is, for us, the biggest risk right now when you invest in fixed income. And it protect against inflation risk. We have covenant. So even if we are first in secure, there's a lot of in the contract that prevent the company to do, let's say, bad thing for us. Like, I have a good idea to buy another company. No, you cannot do this. You have to first pay me my loan, and after that, present a plan, and I will decide to invest or not. But you have to pay me first. So it's very interesting in terms of covenant. Now the process, if we go to page 20, we receive maybe between 6 and 10 new loans, okay, a week. Don't forget that this is a huge market. There are more than 1,200 loan issuer in the index. It's 1,100 billion market, a very big market. So when we receive it, we do a primary screening, meaning that all the loans that are small, for us small is less than 500 million, we don't look at it at all. We only look at loan with a good rating, meaning double B and B plus. So the loan with a triple C, we don't invest it. We don't look at this. We don't look at industry that are cyclical, how can I say that? Cyclic, sorry.
Yeah, cyclical.
So, cyclical, thank you. So no energy, no metal and mineral, no aerospatial, because when we lend money, we want to be sure that the money is there at the end of 3, 5, or 7 years, and we don't want to be locked. And let's say the price of the oil go down. Even if you have a good management, you will not be able to have your cash. So we exclude this, and we look at the relative value. If it's a good company, good management, good sector, but the spread, the coupon is too low, we don't invest. After that, we have 2 or 3 companies that we have all the documentation. All this documentation is very specific to company, and it's private. So we have to sign a lot of paper, and we do a quantitative analysis with the structural. We look at this, and we produce a report of 20 pages. That report go to investment committee when we ask more questions, and it's a go, no go, or ask we have more questions. They bring back like the company to investment committee, and we start to build our portfolio. After that, we have to decide if we buy a new issue in the secondary market. Bank loans are very liquid. There are more than 2.8 billion a day that trade in secondary market. That exclude like the new issue. So we like the company right now, but let's say in 6 months we don't like it, we sell it at $100 because it's very stable, close to $100. So we finish with a portfolio of quality loan. We have about 245 to 50 issuer. And in terms of the size, just to give you an idea, the average size of the company, the tranche of the bank loan that we have in our portfolio is more than 1.8 billion. So it's a huge, bank loan with a lot of investor in that tranche, meaning that we have a lot of liquidity. If we look at page 21, we have some company that we have invest in. Dell International, as you know, Dell has more than 71 billion of sale a year, so it's huge. Burger King, we talk about GoDaddy, that is a web base that sell name, and we have some hospital too, HCA and CHG Healthcare Services. So it's very well diversified in terms of industry. That kind of sector or industry, we don't find it in the Canadian market. So it's very interesting. So a lot of these companies are US, but we are hedged for the US currency. Okay, so we don't have currency risk in our portfolio. At the end of March, the portfolio have close to 1.5 billion of asset under management in the bank loan, and AlphaFixe is the bigger money manager and bank loan in Canada. The yield to maturity is 4.51%. So when I told you that's very interesting, you see now what. So in terms of the summary of the bank loan, what we have to remember is that it's a first lien loan only. We have no second and third lien. We are a pure bank loan players, so we have no high yield bonds, no credit derivative, no leverage. We focus on non-cyclical industry. We include ESG criteria in our analysis, and we have actively managed. In terms of the capital structure in page 23, just to show you other company that we have in our portfolio, the green and the orange are like the first tranche. Okay, we have a bank loan and some securitized bond. So what this information, this page give you is you see all the money that are under us that protect us. So if I take, let's say, Allison Transmission, you will see that the bank loan represents maybe 12% of the capital structure of the company, meaning that I have 88% under me that protect me if something happens. So when we say bank loan is very good at the end of the cycle, you see why, and you see that it's not only Burger King, Tim Hortons. A lot of the company that we have the same structure. In terms of annualized volatility, we just want to show you that bank loan is a credit, meaning that when something happens in the credit, yes, the market reacts, but it reacts very fast and it recover very fast. And we show you the volatility of bank loan compared to high yield or U.S. equity. So it is the same shape, but it's very low volatility asset that we have in your portfolio. So we'll finish maybe 5 minutes before, or 2 minutes before the question. If we look at the economic right now, the Fed is expected to stay on hold in 2019. This is what the market expects. Same thing from the Bank of Canada. We don't expect that. We think that they will increase rate by the end of the year, and more in Canada than in the U.S. because the one day year in Canada is 1.75 the overnight compared to 2.50 in the U.S. And we think that with the last creation of employment last month, we create more than 100 new employees in Canada. It's huge. We don't think that the Bank of Canada could stay on hold for all the year. If it's increased, as I told you, the coupon will increase because it's directly linked to that. Okay, so like I told you, we think we are at the end of the cycle, but we still have place. If you look at the curve, the bond yield of Canada on page 28, you will see that the curve don't give us value, meaning that in 2016, if you invest in 2 years compared to 30 years, you give up like 2%. Right now, the curve is totally flat with 2 years at 164 and 30 years at 2%. So you don't have like slope, or you don't pay to buy a third year bond compared to 2 year bond. So we don't think it will stay like this. In terms of economic growth, if you go to page 29, you will see that the U.S. have a very good first quarter, 3.2% of the GDP. And you look at the last recession that was in 2008, like I told you, we are close to the end of the cycle, but not this year. The economy is still very good. If you go to unemployment at page 31, what we look, it's the jobless claim. Okay, so this is not a survey. Okay, people, when they lost their job, they go to directly there to receive some benefit, and you see that we are the 4 week monthly moving average. It's at 212. Okay, compared to 650 that we have. Okay, in the last recession. So that number, the last time we saw this was in the 70s. So for us, the economy is in very good shape with an unemployment rate at 3.6%. If we go to Canada, okay, page 34, still the same thing, except that we have less GDP in the first quarter. As you see, it's lower in the U.S., but we think that it will increase by the end of the year. What is important in Canada is the change, the moving average. If we look at the 6 month and the employment, and we have at 35,000, and this is not include the last that we have in April that was at 100,000. Okay, so it's a huge creation of employment, and our employment rate is now at 5.6%. So it's very low across Canada. So we don't think the Bank of Canada could still keep interest rate at that level. So if they increase interest rate, all the curve will normalize and they will increase at the same time. So our position will pay off. So if I go to the conclusion, economic growth is slowing, okay, but it's not finished. So we still have room. Salary and inflation go up, meaning that because you need more worker, you will have to increase, okay, their salary, meaning that inflation is coming inflation coming, meaning higher interest rate. Central bank, they're still in the core decision, so what will be next, but we think that they will increase it. And we end at the end of the expansion. We like to say that we are in the 8th inning. We can go in prolongation, but for sure we have to be prudent at the end of the cycle. So this completes my presentation, and I will be happy to take questions if you have.
Okay, thank you, Stéphane. So we'll now proceed to answer some of your questions. The first question that we have, what is the decision making process for the manager when he wants to change the proportions between bonds and bank loans?
Okay, very good. If we go to page 12, you will see that first we look at the duration. So the first cause the duration. So we look at where interest rates are, what is the expectation of where interest rate will be, and based on that, okay, we put the duration. Right now we are 4-year under. After that, we look at the spread for the spread product. So the spread and the corporate bond, the spread and provincial bond, the spread and the municipal bond. And depending where we are in the cycle, if the spread are very high, we want to buy it. If the spread are very tight, we don't want to buy it. And it's at that time that we trade the corporate, the provincial, and municipal bond for the bank loan if they give us a good yield. So it's always what is the difference that I have in corporate, what is the spread I have in bank loan, where I am right now in the cycle. So this is done every day because what's happened, and we decide like to make a move or not. If it's a new information that is structural, we will do some move. It's a new information that is punctual. We will not do the move.
Okay. And why are you the only ones offering a product like this in Canada?
Okay, good question. We when we start the product, we are 2 senior person. If we go to page 4, Diane Favreau and Julie Prémont. Diane worked at the Bank Royale and worked at the Caisse de dépôt. She was managing their high yield bond and bank loan since more than 20 years. So when we engaged Diane, she opened the door to us to that product because that product came to a private market. You cannot buy 10,000 Burger King, Tim Hortons if you call your broker. You will not be able to. So we have to have some relationship with the U.S. Bank, JP Morgan, Bank of America, Merrill Lynch, Barclays, and Diane opened us this door. It's for that. So it's more complicated to have access to the product than only provincial or corporate bond. It's for that.
Okay, well, thank you, Stéphane. There's no more questions at this time. So thanks for your time. It was very much appreciated and really interesting. So this would conclude the presentation. To all of you who had listened to the webinar, thank you for your participation and have a great day.